Hello, this is Steve Schwartz coming to you from Market Traders University in the Market Traders TV virtual studio. Today is July 27th, 2009. The dollar fell to near 7-week lows versus the euro, while the yen weakened against all other major currencies overnight. Crude oil rose to 3-week highs, with Brent crude in London reaching above $71 a barrel, and gold is now taking out last week's highs. We're going to focus first on the dollar and how it is setting up the gold market and its seasonality. So let's take a look at the dollar. Here's a weekly chart. Here's the early June lows that we're now retesting. This is Friday's close, and we're starting to roll over in overnight sessions. The 60-minute chart clearly shows that what we've seen since last night is a clear, definitive decline off of Friday's close. We're now drawing that same line in the sand as I showed you on the weekly chart, and it is essential that the bulls hold this line or the bears are going to take full control. Up until now, we have been seeing essentially a sideways trading band, going back to the weekly chart, for the last 7 weeks. We've had established a low here at 78.60, a high of just below 82. Now we're retesting these levels, and it is essential for bulls to hold that line. If not, it clearly shows that we may roll over and then continue to move on a new leg down to the 76 level. Today we're going to be looking at the seasonality of gold. This is a 37-year seasonal chart. As you can see, 37 years is a lot of history, and it does show the market's cycles. I like relying on it not as a decision maker for points of entry or exit, but an overall compass of strength and weakness during the course of the year. As you can see, this is where we are right now going into the remainder of the month. We've got 4 days left. It shows a basic peak during the last week of July into the first day or so of August, basically August 1st, and then you see a little bit of a pullback. This is the area where I am emphatic about looking to buy the market. If the dollar continues its trek lower, or even if it stays in a sideways trading pattern, gold has already shown the ability to rally with the dollar staying in a sideways pattern. Currently, gold traders have been following interest rates, the dollar, and what the stock market is doing. Certainly, the stock market going higher has not hurt the gold market. The dollar going in a sideways pattern short term has not hurt the gold, and interest rates have been bouncing around trying to determine what these budget deficits will mean and how much debt is going to truly be out there in the form of offerings, and that hasn't hurt the gold. Gold and silver are basically marking time, is the way I see it, and demand tends to wane anyway during the seasonal summer, simply because the jewelry industrial demand slackens off. But now the hedgers, the buy hedgers, have to move in to start taking delivery during the fall and winter for their inventory needs. So the tendencies usually point to a softer price during the summer. What is impressive about the gold market is the fact that the market had a very shallow decline in May when the seasonality does start to weaken. And if you recall the chart, and we'll go back to it in just a moment, you see this pullback during the course of the month of June because the hedgers are not there to buy. The market's pretty much left on its own to speculators. Here's that chart once again where you see the market pulls back in June, just like we did right here, and then resumes its course to the upside once this seasonal weak pattern is complete. Well, here's the daily chart. You have your points of resistance. We've taken out the first level of resistance now. The market has had a full week to fail, go back down below it. It's confirmed and held above it. It only means that the path of least resistance is to the upside. The bulls have full control of this market, regardless of what interest rates the dollar and the stock market's doing currently from day to day. This is going to be formidable. I believe this is where the market is going to find some battle between the bulls and the bears. The bears are going to take a line in the sand here. Simply, there is a seasonal pattern, as I had mentioned. We'll go back to it. right here where you start to see the market drifting a little bit lower in terms of seasonal strength or weakness, in this case weakness, and it only stands to reason that with this increase in price we should see a turn back down and maybe a retest in the 950 area once 965 is hit. So with that, try to keep in mind, in my opinion, the next low is when the market starts setting itself up for a year-end rally. And we'll just take a look at the weekly chart. The year-end rally should, after all said and done, test these highs once again or even higher. Because in my belief, as the economy starts recovering, more of the attention is going to be spent on inflationary expectations, what recovery is going to do to amplify those expectations, what the debt is really going to mean in the overall context of federal monetary policy, and there will be more questions and anxiety than there are answers, which in my belief is what's going to drive the gold market well beyond the $1,000 mark. And probably, if in fact we do have a measured move off of this reversal or basic head and shoulders pattern, a measured move would take it up into the $1,300 area, because this would be the neckline. You got approximately $250, $240 move in the neckline. So you add $240 to the highs, and you're looking at $1,250 to $1,300. So with that, keep in mind the seasonality of the market. I'm going to leave you with that chart. It's important to note that overall the remainder of the year does turn positive. There will be times to take profits, and we're going to all follow it. So thanks very much. May the best trades be yours for the remainder of the week. Once again, it's Steve Schwartz from Market Traders TV Virtual Studio. Join us at markettradersuniversity.com.